All right, and here we are, right? So, again, looking at how to secure yourself financially, specifically from morning investing classroom in the feature content course, where inside of that we have 7 modules: stay investment in the market and terms and recoveries, and lastly, asset class and downturn. They also have other sections like risk and volatility data, something that I would like to look, investment strategy for a volatile market. Don't focus too much on the short term and dealing with financial stress. Specifically, these two sections, I will argue that are relevant to the psychological effect or the investor psychology, most likely. So yeah, here we are in asset class and downturn. And because I already saw what are the market downturns and recoveries and the contraction and the expansion, but in a general perspective, or from the bigger picture, now in this section, we're going to look at that, but with respect of asset classes involved, such as stocks, bonds, and some other asset classes uh, with some sample portfolio structure, something that they mentioned here, okay? with some sample portfolio structure. So we also look at the correlation of different assets with a broader or with the broader market. So over the last day, or yeah, over the last couple days, 7 days, I dedicated his time to understand bond yields during recession. First, to understand what is a bond, or at least to have to develop an intuition of what is bond. So, looking at Investopedia, where they tell you is the strict definition, okay, whether there is a fixed income instruments that represent a loan made by an investor to a borrower, typically corporate or government. So I just stick to this idea, right? Or um, uh, the bound definition that I want to stick is
Bonds are
this,
units of
right?
debt issued by
So
companies.
when they mention is that bonds are a unit of debt issued by companies or corporations that can be converted into tradable assets. Okay, I prefer to stick with this definition. Okay, because now you are, or I am able to see that bonds at the end of the day they are debt issued by governments or companies. So when you purchase that debt, you not only become a debt holder, but also they outline the loans, this details, and it is payment. So with this definition, okay, and applying a Pareto principle like 20% of the effort to get 80% of the result, okay, and after all, I'm going to see a more in deep journey of what is bond from the Morningstar investing classroom. So, but yeah, so bond yields, so bonds can be thought as an IOU between the lender and the borrower with loan details and it is payment. Okay, and again, remember that this is a debt issued by governments and corporations that can be converted to tradable assets. All right. So again, here bond yields during recession are, or the bond yields are driven by several factors, such as demand, demand supply, or supply and demand, like you call that. So the supply and demand for loan, monetary policy, and inflation. So because the Fed has the the discount rate, which is that rate, you can look at that. The discount rate, okay, okay, is either the interest rate that the Federal Reserve charge banks for short-term loans, or the rate used to discount future cash flow in discount cash flow analysis. Okay, so you have two definitions of what it can be. I am more familiar with the interest rate charged the interest rate charged to commercial banks when they ask for short-term loans. Okay. The other is the rate used to discount future cash flow in discount cash flow analysis. So when I look at discount flow, cash flow analysis, okay, with a discount cash flow analysis, the discount cash flow explained with a formula and example. A valuation method used to estimate the value of an investment based on its expected future cash flow. DCF analysis attempted to figuring out the value of an investment today based on the projection of how much money it will generate in the future. So based on this projection or this forecast, that is the value of the investment today. Okay, interesting. Example of this. What about this?
Discounted cash flow, or DCF, is a valuation method used to estimate the attractiveness of an investment opportunity. DCF analysis uses future free cash flow projections and discounts them to arrive at its enterprise value, which is then used to evaluate the potential for investment. If the value arrived at...
Wait a fucking single one. Free cash flow. Free cash flow. Free cash flow. Is that huh? Free cash flow. But how can you get free cash flow? Okay, so cash flow is the net amount of cash and cash equivalent being transferred in and out of the company. Okay, or so it can be the cash or cash equivalent being transferred in and out of a company. Free cash flow. Who the fuck give you that, man? Free cash flow. What?
DCF analysis is which is future free cash flow projections and discounts them to arrive at its enterprise value, which is then used to evaluate the potential for investment. If the value arrived at through DCF analysis is higher than the current cost of the investment, the opportunity may be a good one. Jane is interested in buying shares of Miranda Cruises, a solid company trading at $250 a share, a debt of $50 million, and has a steady flow of revenue coming in every year. Jane crunches some numbers and calculates Miranda Cruises' DCF, starting with forecasting future cash flows for the next 5 years. Jane then looks for the company's weighted average cost of capital, or WACC, which reflects the risk of the cash flows, and uses it as the discount rate for the following DCF formula, where R is equal to the discount rate, and CF is Miranda Cruises' future cash flows in multiple periods. Jane uses the formula to calculate enterprise value. She then subtracts the company's net debt from its enterprise value to get its fair value of $215.3 million. Dividing $215.3 million by the company's 1 million outstanding shares, Jane finds that one share of Miranda Cruises is worth $215.30. Since its DCF is below the share price, Jane decides to pass on the investment because the stock looks overvalued.
Because the stocks looks overvalued. The key aspect of this discount cash flow analysis is to estimate the money an investor will receive from an investment, adjust for the time value of money. So the time value of money assumes that a dollar that you have today is worth more than a dollar that you receive tomorrow. But after all, it's like, okay, the purpose of this DCF analysis is to estimate the money an investor will receive from an investment. Exactly, but if you are hoping that someone else will increase your dollar, okay, that might be one way to do that. But I prefer to see myself as an investment. And when you change that mindset in perspective, uh, not only you become more valuable, but also you are driven well by the decision that wants to make you improve or make you valuable in the long run. Okay, so that is learn skill. In my case, learn skills, lay, learn how this system works, and also mention that out to the world. Okay, so that's another reason why I'm recording here. And okay, so discount DCF, the discount, holy fuck, the discount cash flow. Okay, what is discount cash flow? So the discount cash flow is a method that estimates the value of an investment using its expected future cash flow. Using its expected future cash flow. Okay. Um, because this is uh, one of the useful things of the software engineer is that they deal with a lot of abstractions, and these abstractions are crucial to operate in this world, meaning that you don't need to dive in too much in the formula or in the DCF. Again, repeating is or applying the Pareto principles, 20% of the effort to get 80% of the results, is something crucial, especially here, because you want to know enough so you can move on. So defining here what is a DCF that actually comes from the discount rate, because this is one of the primary instruments that the Fed use to set monetary policy, aka regulate economy, along with the federal fund rates. Okay, so the federal fund rate is something that I already know, is the rate at which commercial banks lend fund each other, whereas the discount rate is the rate charged to commercial banks when they ask for short-term loans to the Fed, right? Or, or, okay, interesting. Or the rate used to discount future blah, blah, blah. The rate used to discount future cash flow in discount cash flow analysis. Okay. The rate used to discount future cash flow in discount cash flow. All right. Okay. Mhm. Ooh. So discount rate, okay? Either the interest rate that the Federal Reserve charge banks for short-term loans. I like to use this. It's more succinct, more precise. Okay. So either is the interest rate that the Federal Reserve charge banks for short-term loans, or the rate used to discount the future cash flow in discount cash flow analysis. So for the sake of the example and for the abstraction, I'm going just to learn about this, okay? Uh, Recognize that I don't know dive deep the things about discounted cash flow, all right? Uh, but it's important to know that they exist, okay? And if I want to dive deep into this, yes, I'll do that. But right now, I don't want to do that. I just want us to understand that the discount rate, either the interest rate that the Fed charge banks for short-term loans, or the rate used to discount future cash flow in discount cash flow analysis. Okay? So for the sake of the example, I'm going to live this. And when someone actually asked me, what is the what is the discounted cash flow analysis? Honestly, because I was learning that concept, I ignore that, I abstract that for the sake of the exam, for the sake of my own learning, my own practical learning. That's what I like to mention here. Okay, so for the sake of my own learning, I'm just going to not dive deep into this. But I think this is something important to dedicate time. You know. So what is the trade-off here? Again, applying a Pareto principle uh, to understand this discount cash flow. Uh, so I'm going to learn about this concept, at least uh, the concept. Okay, evaluation method used to estimate the value of an investment based on its expected future cash flow. So based on its expected future cash flow is a method used to estimate the value of an investment. Example of this, based on the future cash flow. And when we talk about cash flow, the US, the net amount of cash or cash equivalent being transferred in and out of a company. So, cash flow is the movement of money in and out of a company. Cash receives significant inflow and cash spends significant outflow. The cash flow statement is a financial statement that reports on company source and uses of cash over some time. A company cash flow is typically categorized as cash flow from operations, investment, and finance. Interesting. From a company. If I see myself as a company or a business, this is something that I need to dedicate time here. Okay? Cash flow from operations, investment, and financing. Okay. There are several methods used to analyze a company cash flow, including the debt service coverage ratio, free cash flow, and unlevered cash flow. Because according to uh, cash flow, I'm going to link that to another course or another learning course. such as the how to become a business freelancer, how to become a business consultant. Mm, mhm, is here. Okay. So Paul Menders in from Zero to Mastery mentioned that so Paul Mendes from this course and how to become a business consulting freelancer, when he talked about the foundation of consulting, which is the cash flow, he mentioned that cash flow is the ability to earn income based on the potential and the value you provide. Okay. Again, this is for business. This is one perspective, and also I am applying here the devil advocates. So Paul Mendes mentioned that cash flow is the ability to earn income based on your potential and the value you provide. Okay, that is his definition. But when it comes to Investopedia, in terms of finance, okay, that cash flow is the net amount of cash and cash equivalent, and it's not or, and cash equivalent being transferred in and out of a company. Okay.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies. Ed makes his living running Ed's Carpets. For Ed, cash flow is essential to the survival of his business, as well as his personal finances. Having ample cash on hand ensures that Ed can pay his employees, his creditors, and himself on time, keeping the business afloat. The same goes for Ed. He needs enough cash in his personal bank account to pay for his house, his car, and other personal expenses. Whether we are talking about Ed or his business, there are generally three types of cash flows. 1. Operational cash flows refer to cash received or spent as a result of a company's business activities. For example, a business like Ed's Carpets brings in cash by selling carpets and sends cash out to pay employees and suppliers. Similarly, Ed pays himself a salary, providing cash flow to his personal account. Cash will flow out to pay for his expenses such as food and housing. 2. Investment cash flows refer to cash received or spent through investing activities, basically the purchasing and selling of assets that will help grow the business, or in the case of Ed, assets that will help increase his net worth. 3. Financing cash flows refer to cash received through debt or paid out as debt repayments. For a company, issuing stock, paying down debt, and repurchasing shares would count as part of financing cash flows. For Ed, financing cash flows include any cash coming from loans or other types of debt, as well as payments going to pay down debts. If Ed's business comes up short on cash and is unable to pay its obligations, it will experience a cash flow crunch. To avoid insolvency, Ed will have to arrange some type of financing or bridge loan. A similar situation in Ed's personal accounts would also have disastrous effects that could lead to personal bankruptcy if the cash flow crunch persisted. For this reason, it is important that businesses and individuals manage their cash flow carefully and set aside emergency reserves to cushion any unexpected events.
Even though they tell you that. Okay. Um, so, from the business perspective or from Paul Mendes' perspective, this is structure from Zero to Mastery. He mentioned that cash flow is the ability to earn income based on your potential and the value you provide. So two metrics here: your potential and the value you provide. Great. Cool. Okay. Great. Your potential and the value you provide. Okay. your potential or the value you provide. So understanding here cash flow.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash
Exactly. This is strictly to that. It's not about providing value. It's not about your potential. It's in the context of business is the movement of cash into or out of an account, a business or an investment. So it's cash in. Uh, exactly. It's the movement of cash. It's the movement of cash into or out of an account, a business or an investment. So this can be applied not to any business, yes, any. So the cash flow is the movement of cash into or out of an account, a business or an investment. And the mention is the type of
account, a
cash.
business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies.
Make a pause here. Okay. So, for the sake of the video, okay, what are the things that I've learned so far here? Because I was looking at so it all starts with bond yield after recession. There are several factors uh, or for that. For in bond yields, there are driven factors such as supply and demand for loans, monetary policy, and inflation. Okay, so the Feds have several tools like federal fund rates, the rate at which commercial banks lend fund each other, and the discount rate, a rate that the Federal Reserve charge banks when they ask for short-term loans or for short-term loans. Okay? For short-term loans, or the rate used to discount future cash flow. In discount cash flow, so discount cash flow is a method of evaluation, a valuation method used to estimate the value of an investment based on its expected future cash flow. And future cash flow here uh, is the net amount of cash and cash equivalents being transferred in and out of a company. So, in other words, the cash flow
To the movement
is
of
the movement of cash into or out of an account a basis of an investment. Okay. So how much cash that company has? Perhaps there is a lot of people uh, actually investing in a or purchasing share or purchasing stocks in a particular company. Example: Tesla, Apple, Google. All of these top companies. And to me, it's funny because it's like, yeah, OpenAI, this company, OpenAI has launched to OpenAI has 10 billion investment in a multi-billion dollar investment. So OpenAI stocks or EPO, initial public offer, OpenAI stock EPO. Can you invest in this Elon Musk company? OpenAI EPO, wealthy billions. Big data is the oil of 21st century. And is it clothing? Is it a the golden age of the data 21st century oil. Another Musk venture, OpenAI ChatGPT, OpenAI stock EPO, OpenAI stock price, OpenAI stock alternative, OpenAI stock alternative. While OpenAI has not filed for an EPO, you may be wondering how much will OpenAI stock be worth? There are a couple of ways to evaluate privately held business, but OpenAI is a unique position. Valuing a startup is already immensely difficult, especially a technology startup lacking sales growth projections and a clear consumer base. Typical fundamental analysis using the income approach, industry peer, weighted average cost of capital, and pro formula financial will absolutely not work. Okay. Do you use market multipliers or preceding transaction? Who knows? That's ultimately for you decide to do something a price. Here's a few variables that could drive the stock price: capital structure, management team, sales growth, historical earning, free cash flow, a concept that I saw, and dividend policy. Artificial intelligence and machine learning is a new innovation less than a decade old. However, based on the first billion Microsoft bet and 50 million share outstanding, a 20 share price will appear appropriate. $20 share price will appear appropriate. But again, this is the variables that could drive the stock price. Capital structure, management team, sales growth rate. I've told you need management. You need someone that maintain that company system, whatever. You need someone that maintain that. Also, sell that that can sell that based on the solution selling process. Okay. Historical earning, free cash flow, and dividend policy. And capital structure. And after all, is look at the outcomes. So that's why most salespeople here are looking at that. It's like outcomes. Outcomes. What is the result of this? Artificial intelligence and machine learning is a new innovation, less than a decade old. Okay. But in any case, because I'm looking here at the if OpenAI is an EPO, uh, and see um, the several concept here uh, that start from bond yield during recession. Okay, so bond yield during recession, yes, okay, are driven by or bond yields are driven by several factors such as supply and demand for loans, monetary policy, and inflation. The Fed has two primary tools like the discount rate, the rate at which Federal Reserve charge banks for short-term loans, or the exactly, or the rate used to discount future cash flow in discount cash flow analysis, or the rate used to discount the, the rate used to discount future cash flow in discount cash flow analysis. Is a rate used to discount future cash flow. So what is cash flow, right? Oh well. Now what is this DCF? Okay, what is this discount future cash flow? Is the valuation method used to estimate the value of an investment based on the expected future cash flow. Meaning, with future cash flow is the movement of cash in or out of an account, business, or an investment. So the type of cash flow are typically categorized on operations, investing, and financing. Okay? From operations, investing, and financing. Uh, so with that, so I can move on, talk about uh, what happened during a contraction phase where the Fed lowered interest rates to stimulate consumer spending and decrease the cost of borrowing. And during an economic expansion, the Fed want to make they want to keep inflation in check and tightening monetary policy by increasing the interest rate. So the federal fund rates, or particularly the treasury bill, because here we're describing is the discount rate, okay, and how the Fed used that tool, the discount rate, uh, to set the monetary policy, to regulate the economy. And when we talk about the federal fund rates, so the Treasury bill has a close correlation of the federal fund rates, which the Fed targets through open market operations. They want to put that interest rate at yeah, they want to set that target, the federal fund rate, this rate at which commercial banks lend fund each other by buying and selling government securities in the federal open market. Okay, right. So I'm going to end this video with that, and then I can move on to the other topics. But yeah, so with that, take care. Bye bye.